Hello and welcome. You're tuned into CNBC-TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha Gupta and with me is Nigel Dsouza, bringing to you the latest dose of commodities and cryptos and currencies. So what do we have today, Nigel?
Well, plenty is going on in the cryptocurrency space, the commodity space as well as currency space. But before we get to that, let's do a quick check on what went on Wall Street. We witnessed upbeat trade, remember, overnight. And now we have the stock futures that are firing away. Both the S&P 500 and the Nasdaq have surpassed their all-time intraday highs, staging a resilient retreat from the lows that we saw in April. U.S. equities are now poised to close the week well in the green. Gains have pushed the Dow as well as the S&P 500 up more than 2% in this week. The Nasdaq has jumped more than 3%, and that's been the one that's been outperforming after the tech rally has come back to the fore. There's a slew of macroeconomic data that's awaited, which includes the inflation reading, and traders will keep a very, very close watch on the personal income, consumer spending, as well as consumer sentiment data. And in turn, what will the Fed do post these cues that come in? But let's take a check on the Asia-Pacific market. Well, it's mixed trade more or less out there. The Japanese Nikkei, well, that scaled a 6-month high. On the flip side, however, the Shanghai market is struggling yet again. It's taking it on the chin, actually. It's down close to around 0.7 of a percentage point. But back home, the Nifty is at the day's high. Yesterday, there was a very, very strong close to the June series. Now we're starting off the July series with solid gains. And, headlines have shifted really from politics back to tariffs. And in fact, overnight, the White House has hinted at a potential extension beyond July 9th deadline. Let's hear out what White House Press Secretary Karoline Leavitt hinted at an extension in a press briefing. Let's hear her out.
The deadline is not critical. The president can simply provide these countries with a deal if they refuse to make us one by the deadline, and that means the president can pick a reciprocal tariff rate that he believes is advantageous for the United States and for the American worker, and he will continue to do that.
Well, of course, a clarity on that tariff deadline would be important to understand on. But on the meanwhile, the dollar index continues to hover around those 3.5-year lows as traders now weigh on the Federal Reserve's rate cut plan. But oil is gearing up to nurse steep weekly losses amid fading supply risk. Despite recent draws in U.S. crude and the fuel inventories, the market's focus is shifting to potential tariff removals and the upcoming OPEC Plus meeting in early July. Street now expects that an increase in OPEC's production could lead to a significant oil market surpluses by the end of this year, assuming that the continued regional stability is what we would perhaps see going forward.
All right, let's take the discussion forward then and welcome our first guest on the show. We have James Davis, the Director of Short-Term Global Oil and Head of Upstream Oil, FGE Nexatica. Hi, James. Good to see you in. Thanks a lot for joining in. Well, the good news is that, in fact, the geopolitical issue has cooled off. The bad news is for those that were bullish on crude oil prices, because that price has cooled off by more than $10. How do you see things shape up for the crude oil market? And also, we've got that OPEC meet. What are the expectations out there?
Absolutely. You've already touched on a couple of the points which are critical for the geopolitics for oil in the coming months. Anyway, the potential end of the US administration's 90-day pause on reciprocal tariffs, it ends in 2 weeks' time, and that can be both bullish and bearish depending on what they decide. Obviously, the news over the last few hours, as you've highlighted, is signaling that maybe slightly more constructive for prices if they do another pause. But equally, it can come back, it can be tougher tariffs, higher tariffs, and that can be detrimental to demand. And that's going to knock market sentiment, and that's going to weigh on prices somewhat. So we can already see this morning, as you're flagging up on the screen, an uptick in crude prices as the market responds positively to the potential pause. We think particularly diesel will benefit if there's a pause, and we can see the upside specifically in the US in the manufacturing sector. So these things are on a positive trend right now. But whilst we may have also seen the end of what was pretty severe conflict in the Middle East between Iran and Israel, that story is also not over just yet. We may have that ceasefire, we may have a rhetoric right now which looks like people are nudging towards some sort of deal, but the path that Iran have is still far from unclear. in the months ahead, and also towards the end of the year. I think a lot of people right now think it's going to be business as usual, as things seem to be very calm. But there's still some huge sticking points when it comes to negotiations between the US and Iran, mainly around the nuclear program, which can also create a huge amount of challenge for supply from Iran towards the end of the year. And that can send the market on a very different path from what's currently priced into.
Well, as you said, James, there's clarity awaited on a lot of fronts there, including tariffs and, of course, on what happens with the Iran, Israel and US and Iran as well. But I want to take a step back and talk about on how this week was. The crude oil prices are down by 11%. This is the worst weekly decline that we've seen in 2 years. It has been a very, very volatile week as well. Every day we've seen 5 to 7% of moves. Is this something that we should be getting used to now?
In terms of what the market's pricing at the moment, you can see if you look across the forward curve, you've got two very different stories. You've got one at the front where you've got very steep backwardation because the main theme there is oil stocks are incredibly low, and that's keeping the physical market very, very tight. But as we look towards the end of the year and into 2026, the market's pricing for what it expects to be market length and stock builds. And so we can see December 25 versus December 26 spreads in contango as the market's bracing for that length. So we're stuck between two very different stories. The market's pricing it in incredibly well. It's just that's the challenge we've got. If we actually looked at where we are today, it does feel tight. And so the way the market's pricing in these forward expectations, it's keeping downward pressure on the overall flat price. And when we do have these supply shocks, when we do have suddenly 20 million barrels from the Strait of Hormuz at risk, as people were anticipating over the last 2 weeks, the market will respond and it will spike higher. So we're in a situation where anything major can send huge shockwaves through the system, and we can see that sort of volatility.
All right, James, if you were to put a level to it, in terms of the way crude oil prices are going, the market as is was in oversupply, right? And then, in fact, you had action coming in from the OPEC. But then suddenly you had that blowout rally because everyone was fearing that the Strait of Hormuz was going to get closed, which didn't happen. If you take all the variables together, what is the broad range you're looking at with regard to Brent crude prices?
I think a very good way to consider it is where market structure is and where it moves. If we look at where global oil inventories are right now, in any normal environment, if the market was pricing that in fairly, we could expect to see fairly steep backwardation across the entire forward curve. Perhaps up towards $10 a barrel of backwardation between prompt prices and prices at the tail. And that could lead something like $75 to $80 a barrel at the front, if we were pricing in exactly what we see today in stocks. But the market's looking forward. The market's looking to stock builds that it's going to see in the fourth quarter, that it's going to see in 2026, and it's already anticipating those stock builds and pricing that in. And that's leaving market structure almost flat across the curve. And so the range that we would consider is perhaps something that sits in between those two boundaries. There's also a lot of uncertainty of what OPEC Plus will do in the months ahead. They've been accelerating their cuts, unwinds, and so if they continue on that path, that will add a lot more oil towards the end of the year. And then what they do beyond that also remains somewhat of an unknown. And that can also send the market in a very different trajectory. So there's a lot to consider. Right now, we could maybe see a range of market structure sitting between flat structure and backwardation of $10. That means somewhere between anything from $60 to $80 a barrel still is the range right now in the short term, which is a huge range.
It sure is. A $20 range is what you're talking about here. I also want to talk about some macros right now. And we've seen a huge volatility in crude oil prices, but we also have seen a huge amount of volatility when it comes to dollar index as well. That one is down 11% in the first half until now, trading at a 3.5-year lows perhaps. How are you looking at the macros playing, especially the dollar index? Where do you also see the levels taking some support?
Well, as far as the dollar is concerned, a weaker dollar can help support prices. So we wonder, if the dollar had actually been that much stronger, how low would we have gone at this point in time? And if we were perhaps with a Dixie that was above 100, perhaps we'd be below that 65 level. that would be close to 60. In terms of the trends and the macro drivers there, now, a lot's going to depend on exactly how these reciprocal tariffs are agreed or play out in the weeks ahead. So it's really a very tricky market to call on that front. It's not something that FTE specialises in calling US dollar exchange rate fundamentals, but really the impact on price is what we would look at, and prices could be a lot lower if the dollar was a lot stronger. That's the upside.
So, James, are you saying that you expect, are you saying the dollar is going to get expensive, go higher from here? Because from where we are trading right now, it's trading at a 3-year half lows versus the euro, the pound, multi-month lows versus other various currencies as well. And there are various reports suggesting that we could be looking at the dollar index going all the way down to perhaps 94, 95. If there was a range that you had to put out for the rest of this year, what would that be?
Well, we would follow the market's trend on that. Oil is what we specialise in at FGE Nexon. So if that's where the market's looking to go, down to 94, that's going to be pretty constructive to underpin the fundamentals on how we would actually price crude.
Oh, well, absolutely. Jim's also comment on the kind of crude supplies that we have currently. And as you mentioned, that we're looking at a surplus perhaps going forward into 26. What is it that you would say is the global supply and global demand that you're penciling in for this year? And how is that number changing for 2026?
Well, for demand, we're looking at around 1 million barrels a day of growth. And when we think about the elements of that demand, one of the most important things to consider right now is what's actually making up the supply that feeds that, not necessarily just the crude oil production, but actually from the biofuels and the renewable sector. And we have around half of the demand growth this year being met by non-crude-based type of oil supply, be it ethane, be it biofuels, be it on the LPG front. So when we say 1 million barrels a day growth, really we only need about 500 kbd of crude or the traditional OPEC type supply to meet that. And that's one of the biggest challenges that we're seeing with the balance this year. We've got a lot of non-OPEC supply growth coming. We've already seen fairly healthy levels for the first half of the year. There's a lot more to come from Latin America in the second half of the year. And then when we feed in what's happening with growth from these renewable sources, that's what's going to drive the surplus that we see, especially then as we've got OPEC Plus accelerating its unwinds. So when we think about supply, it's a bit of a moving target because we still don't know what OPEC Plus plans are going to be for the rest of the year. So it's difficult to commit to say exactly what the number is. We think the group are going to accelerate their unwinds all the way through to October, and that will leave a bit of a surplus in the market of around 1.5 million barrels a day in the fourth quarter. And that's the number that we're going to carry into 2026. And from there, it really depends on what OPEC Plus plans are. We think they'll be in a very strong position to move back into a market management mode for 2026 once they've unwound these cuts. Okay. And that can create some sort of support next year.
James, my final question is about the fuel demand peaking out in the global markets. While the IEA report suggests that will happen in 2029, China seems to be peaking already, and it's been preponed to 2026 perhaps. Are there any years? Is there any data that you have that you can share with us?
This lends back to how we actually look at the consumption. Liquids demand, for whatever consumption purpose you're looking at, will be continuing to creep higher, but the makeup of that and the marginal supply into that can continue to be from the renewables and the biofuels and the green elements, the green molecules. And so the incremental demand for crude and traditional hydrocarbons on the liquids front is where we will see challenges in absolute growth. So it's more of a plateau as we get into the 2030s, rather than saying like that's the peak and then it's going to drop off. But the key thing to watch is how the renewable space feeds into this and how that impacts negatively the hydrocarbon element.
Okay, all right. Thanks a lot, James, for joining in. We look forward to chatting up with you in the coming weeks as well. Appreciate you joining in on CNBC-TV18 Prime. Well, time to slip into a snappy break, but on the other side, we've got more focus on commodities. We'll put the spotlight on precious metals this time around. Moral Tucker of Ashoka Global is waiting by. Don't go anywhere.
Welcome back, and without further ado, as promised, let's bring in Monal Thakkar, MD Ashoka Global. Monal, there's a lot to make sense of what really seems to be happening in the precious metals market, but I want to start with gold first. And we've made all-time highs in this year, and then we've seen that correction, and then now we're looking at consolidation, and now the gold has stopped reacting to any news of any kind. How do you read it?
So we have started the year with the 100% nicely news factors of tariff, right? Which has created the jump from, I believe, from 2,600 to 3,500, what has gone ever high, or the lifetime high, which has created the big mass between the London and the COMEX. And the whole metal flew in this particular time to COMEX on the spread side, on the demand side. At the same time, the central bank started demanding on the tariff fear, liquidity, monetary, everything has gone positive for gold, which has created the market at 3,500, which is right now we are 200 away from the lifetime high. Now the relation started, the COMEX as EFP has calmed down. Now there is no more, which is hawk in the COMEX or in US. The whole gold, which has gone externals, has came back to the London or started coming back to the London or the Middle East and the eastern part. So as you said, it's consolidation period. Even the geopolitical impact is not giving the jump or even a slight high to the gold.
All right. Hi, Monal. Good to see you, Ben. Thanks a lot for joining in. Monal, as you said, maybe it's time for some kind of consolidation after the big run. But there are some outlandish calls that are coming in there with regard to a bigger move for gold from here on. Which camp would you be at? Sub 3,000 or closer to 4,000?
So I am closer to 4,000 for sure in the December 25, if you see.
Oh, wow.
But it is going to be a little consolidation before it start on running that side.
So, Monal, you're talking about a 20% move even from here?
I'm very much bullish because I'm not seeing anything which is getting relaxed in terms of the tariff or the geopolitical, because this is a year of events. I have not seen any week which has not gone outside the events, right?
But that is absolutely making an impact on the demand, isn't it, Monal? With these higher prices, with this volatility, would you say demand is getting impacted?
We have not seen, I mean, for us, it's a global business, right? So if you see the first quarter, the US or the western part has gone in the huge demands. Post that, eastern part or the China southeast has gone in the huge demand. So even at this price, the market is not giving that, suppress on the demand. But yeah, of course, a little bit impact, which is going to happen, which is, I believe, after 6-8 months, you will see the demand where the people used to buy, let's say, 1 kilo now, they are going to buy maybe a 500 grams because of the price factor.
Monal, what about the role of the central banks? They have been the big buyers, right? Tanking up. And that was where the first indications came with regard to the big gold move. How do you see action pan out there? Because they are the big drivers.
It is a big driver from 2022, sir. So basically, all the central bank is just acquiring the golds, of course, against the Fed, the interest rate cut, many events, which is converting them to make the gold in their store. Still, the demand is there, directly and indirectly, both the way.
Okay. Monal, that's about gold, but what is also your sense on the silver prices now? Because that seems to be consolidating better, and this is an area where most analysts, banks and brokerages feel that the silver prices could outperform gold going forward. We've seen that happen in the very near term, week-on-week basis, month-on-month basis. Silver clearly has outperformed. Are you more bullish silver than gold? And what are your targets for this one?
I'm very, very much bullish.
100% bullish.
100% bullish. Cannot be more bullish on anything else.
Okay.
But yes, because silver has moved, yeah, of course. If you see in last 11 months, it has moved from 22 to 37 now. And I think from 32 to 37, it's just the last 10 days. So I'm still bullish. Still, I'm seeing more 25% higher, maybe near to the year end.
The other big mover has been platinum. Even
Yes.
overnight, that was the big mover. I was watching, various experts overnight, and some were talking about another 10% move on the upside from here. But then there was a contrary view that said that after that 10% move on the upside, we could even pull back 25% because that's been the nature of platinum move. What do you think about that price move? It's been a sharp, sharp move overnight and in the last 1 month as well.
That's true, sir. So platinum has moved, I think, after 2014.
Yes,
About
2013, 14. Yeah.
yeah, about the 1100, which is, and in last, I think 9 session only, it has moved 40%. So, but I'm not having so good view on it. It will stable here or come back, but no, I'm not so bullish on that matter from here.
Monal, coming on the macros as well, because as the reports read right now, 23% of a Fed rate cut opportunity or forecast rather for the month of July and a 93% possibility of a US Fed rate cut by the month of September. Would you see this as one of the market movers going forward for the precious metal? Because we've seen various other banks come out and make their rate cuts. US Fed is something that the street is watching for.
Correct, but I think if you see the number on the Fed, inflation numbers, many events, this, I don't think so that will impact the gold. Many other things will also impact the gold. So not only the geopolitical, not only the demand and supply, not only the one side tariff scenario. So other things also will convert into the demand or supply, or I can say the pricing.
Okay.
So if the Fed comes out with the rate cut or anything else, but the gold can, act differently because the one rate cut we have already discounted. That one will come, which has not came, and the gold has not reacted anything more than $40 in that day. So I don't think any more impact will gold. If yes, of course, if 50 basis point comes out with the Fed, it can be.
Monal, as you said, I mean, you have a global business. You do gold and silver majorly there. What economies or what geographies, rather, have you seen do better than the others?
Southeast Asia is
Okay.
doing very good. Middle East is doing good, other than some of the region. And of course, India, I'm very, very much bullish.
For the Indian markets, is it about the retail demand or is it more to do with investment? ETFs have done quite well as well, but the retail jewelry bullion demand, how has that been?
Bullion demand this year, it's a little bit slower. First quarter, it was good. ETF, yes, people have moved a lot of into ETF, and the ETF numbers shown us that the market is growing in that region. And I believe, yes, investments in the bullion bar has increased in India.
Monal, how would you also look at the prices going forward? I mean, as you said, you're more towards 4,000 when it comes to gold, more towards $40 when it comes to silver as well. Do you see prices holding there? And would that make a lot of impact in sense of buying then? Because we've seen retail slow down slightly in India, China, Southeast Asia. That's all where the retail buying happens because everywhere else it's an investment demand. Do you see a pattern in buying when it comes to gold and silver with the kind of numbers and levels that we're talking about?
So if I see the history of the gold in 1999, the gold was trading at 295 or 300, where India is importing some 600, 700 tons. In 1200 and 1400 level, we were having the same question what you asked right now, and
Okay.
in 24,000, 2400, we were having the same question. I don't think so. India is always in the love of the yellow metal, and it is always going to be on a buy side. Of course, it could be possible that maybe who's used to buy a 10 gram going to buy 8 gram, 7 gram, but it is always going to be in a demanding market or the purchasing market.
And that point is well taken, Monal. Thank you so much for joining in. So clearly, very, very bullish cues coming in for our gold and silver prices. But Nigel, a point that you well put there, that At $300 an ounce, it was expensive.
Yeah.
At $3,000 an ounce, it's expensive. I think going forward, when it comes to 4 and 5 and 6,000, we'll say it's very expensive.
It's expensive, but as you said, right, you've been telling me for the last 13, 14 years that we know each other itself. It was expensive. It's getting more expensive.
And you've been buying.
I've been, but not as much. That's a bit of a regret.
Never satisfied, are we?
All right, well, that's it on this edition of The Big C. Looking forward to chatting up with you all in the following week. But stay tuned. Lots of news updates coming up on the other side.